Have you ever wondered, should I keep my money in a fixed deposit or invest in mutual funds? Your parents may tell you, put your money in an FD. It's safe. Okay. Your friends may say, mutual funds give much better returns. So, who's right? The truth is, both can be excellent investment options, but only if you use them for the right purpose. Choosing the wrong one could mean losing years of potential wealth. Choosing the right one could help you achieve your financial goals much faster. In this video, you'll learn what is a fixed deposit, what is a mutual fund, major differences between the two, returns risk, liquidity, taxes, and inflation. Real life examples, which one is best for students, salaried employees, business owners, and retirees. And finally, which option should you choose? Let's get started. What is a fixed deposit FD? Imagine you have 1,000. Instead of keeping it in your savings account, you give it to a bank for a fixed period, say 1 year, 3 years, or 5 years. In return, the bank promises to pay you a fixed interest rate. This investment is called a fixed deposit, commonly known as an FD. It's one of the oldest and most trusted investment options in many countries. How does an FD work? Here's a simple example. Suppose the investment, $10 interest rate, say 6. 5% per year. Duration 5 years, your money grows at a predetermined rate. Regardless of whether the stock market rises or falls, your interest generally remains fixed according to your FD terms. That's why FDs are considered predictable and stable investments. What is a mutual fund? Now let's understand mutual funds. A mutual fund collects money from thousands of investors. Instead of investing alone, everyone's money is pooled together. A professional fund manager then invest this money into GABAs, stocks, bonds, government securities, gold, international assets. Or a combination of these investments, the value of your investment changes based on the market performance. Unlike an FD, mutual funds do not guarantee fixed returns. However, they have the potential to generate significantly higher long-term returns. Simple example, let's compare. Rahul invests $10,000 in an FD. Priya invests $10,000 in an equity mutual fund. After 1 year, Rahul earns around 6 to 7%. Priya's investment could gain 15%, gain 20%, stay flat, or even decline temporarily. This uncertainty is called market risk. But over longer periods, well-diversified equity mutual funds have historically delivered stronger growth than traditional fixed income products in many markets. FD versus a mutual fund. Quick comparison feature. Fixed deposit. Mutual fund returns. Fixed. Market-based risk. Very low to high wealth creation. Moderate, high long-term potential liquidity. Limited in some cases. Usually easier, depending on fund type, tax efficiency. Often lower, can be more tax efficient, depending on country and holding period. Inflation, protection limited. Better long-term potential. Suitable for conservative investors, growth-focused investors, returns comparison. Let's discuss the biggest factor. Returns, fixed deposit. Typical annual returns may range between 5% to 8%, depending on style, country bank interest rate, cycle. Deposit tenure. The biggest advantage? You already know approximately how much you'll receive. No surprises. Mutual funds returns are never fixed. Historically, diversified equity mutual funds in many markets have produced approximately 10% of 15% annualized over long investment periods. Some years can be outstanding. Some years may be negative. That's completely normal. Which one wins? For short-term certainty, FD wins. For long-term wealth creation, mutual funds generally have the advantage. Risk comparison. Let's talk about risk. Fixed deposit risk is relatively low. Your money doesn't fluctuate daily. You know your maturity value in advance. However, keep in mind that deposit protection limits vary by country and institution. Mutual fund. The risk depends on the type of fund. For example, the equity mutual funds higher risk, higher return potential. Debt mutual funds lower risk, moderate returns. Hybrid funds balanced mix. Moderate risk, moderate growth. Inflation to the silent wealth killer. Suppose inflation is running at 6%. Your FD earns 6%. What's your real gain? Almost zero. Your purchasing power barely changes. Now imagine your mutual fund earns 12%. After accounting for inflation, your wealth has grown meaningfully. This is why long-term investors pay close attention to inflation. Liquidity. Sometimes you need money urgently. Let's compare. Fixed deposit. Breaking an FD before maturity may result in CAISH, penalty, reduced interest. Early withdrawal conditions, mutual fund. In most open-ended mutual funds, you can redeem your investment on business days. Money is usually transferred within a few working days, depending on local regulations and fund type. Some funds may also have exit loads or redemption restrictions. Taxation tax rules differ from country to country. Generally speaking, FD interest earned is usually taxable according to your local tax laws. Mutual funds tax treatment depends on CA, fund category, holding period. Country-specific regulations. Always check your local tax rules or consult a qualified tax professional before investing. Investment horizon. If your goal is GI, less than 3 years FD often makes more sense if preserving capital is your priority. More than 5 years mutual funds may provide better long-term growth potential. The longer you stay invested, the more time compounding has to work. Power of compounding. Imagine investing $200 every month. If your investment grows at approximately 12% annually, over many years, compounding can significantly increase your wealth. The earlier you start, the more powerful compounding becomes. That's why time is often more important than timing. Who should choose an FD? An FD may be suitable if you are a retiree seeking predictable income, saving for a short-term goal, building an emergency reserve, very uncomfortable with market fluctuations, looking for capital stability. Who should choose mutual funds? Mutual funds may be suitable if you are a young investor, building long-term wealth, planning for retirement, saving for children's education, investing for financial independence, comfortable with short-term market ups and downs. Can you invest in both? Absolutely. In fact, many experienced investors do exactly that. Example: emergency fund, FD, long-term wealth, mutual funds. This creates a balanced financial strategy. You get stability and growth at the same time. Common mistakes to avoid. Mistake number 1. Investing everything in FDs. Your money may struggle to outpace inflation. Mistake number 2. Putting all your savings into equity funds without understanding market risk. Mistake number 3. Expecting mutual funds to double your money quickly. Investing is a marathon, not a sprint. Mistake number 4. Withdrawing investments during temporary market declines. Successful investors usually stay focused on their long-term goals. Real-life example. Let's compare two friends. Alex invests $10,000 in an FD earning around 5%. Jordan invests $10,000 in a diversified equity mutual fund. After 1 year, Alex knows almost exactly what he'll receive. Jordan's investment may fluctuate. After 15 years, Jordan's investment has the potential to be significantly higher if markets perform well over the long term. Alex's investment has grown steadily, but at a slower pace. This example highlights the trade-off between stability and growth. So, FD or mutual fund? The answer depends on your financial goals. Choose an FD if you want. Capital protection, stable returns, short-term savings, predictability. Choose mutual funds if you want. Long-term wealth creation, higher growth potential, inflation, beating returns. Compounding over time. There is no universal winner. The best investment is the one that matches your goals, time horizon, and risk tolerance. I hope this video helped you clearly understand the difference between fixed deposits and mutual funds. If you found this guide useful, please like this video, share it with friends and family, and subscribe to BNR Universe for more easy-to-understand finance and investing content. Thanks for watching, and I'll see you in the next video.